In this episode, you can get to know two really underfollowed investors. Mark and Raphi of Stonehouse have built an impressive track record over time. And all of this while they're really concentrated in their style of investing. A warm welcome to the Good Investing Talks podcast. I'm your host Tilman Fersch, and I'm very happy that you're discovering underfollowed investors and underfollowed companies together with me. Before we jump into the conversation, I want to share the disclaimer with you. To sum it up, it says that this podcast is no investment advice and no recommendation. So please always do your own work. And now, without further ado, enjoy the conversation and don't forget to like and subscribe to this channel. The audience of Good Investing Talks, it's great to have you back at the podcast. And today we're really having one of the underfollowed or underdiscovered investment firms here. Welcome to Mark and Raphi of Stonehouse Partners. Great to have you here.
Great to be here, Tilman. Nice to see you again.
Great to be here, Tilman. Thanks for having us.
You're both located in the US, I think, on the East Coast. I think Mark is in Florida. And Raphi, where are you?
I live in Westchester now.
Okay. It's very interesting. I'm in Germany, so we have some kind of time difference and also like a heat difference. We already, in the pre-chat, I talked to Mark and told him that we have snow outside. You don't have this in Florida. That's a good thing about Florida.
Right now, there's no snow.
That's good. But I hope we make also not only in a cool conversation, but also some kind of warm insights into your business and the way you do investing. Maybe let's start to think about the Stonehouse you have in your name, because your partnership is called Stonehouse Partners. And a Stonehouse isn't a typical house if you think about the US. Most houses there are made out of wood. Can you please maybe also, to think in this metaphor, name 3 points where you think your approach is outstanding to compare to the typical house or partnership in investing in the US?
Yeah, well, I just, going back to the name Stonehouse, there's not much, huge story behind it. I grew up, I love to ski. And, when you're starting out a fund, this is back in 2010 when I was starting out the fund, you write down all types of names that you could choose, and a lot of them end up being taken. This capital, that partners. And I found Stonehouse. It's just a street up in Vermont on a ski mountain, nearby a ski mountain where I like to ski at. And that's where really the history of the name came from. I guess if we had to think about how Stonehouse, plays into how our partnership has evolved, we like to think that we have a very good foundation, and I think that comes from having, what Raphi and I talk about often is we're very lucky to have exceptional LPs who really have embraced our strategy and allow us to invest the way that we think is correct, to go for the exceptional outcome over many decades, which is what we're really going for. Raphi, what would you add?
Yeah, I think it's, naming a fund is always an interesting process. I think for us, our LPs are what allow us, as Mark said, to have the strategy that makes the most sense for us. And so they are the foundation of what we are able to do. And, I think while it might not have been the reason he named it, Mark named it at the time in 2010, I think it does kind of make sense in the context of having that strong foundation that allows us to be somewhat unusual in the industry, but, allows to, Stonehouse has now been around for 13 years and allow us to have the success we've had.
Though, let me stay a bit in this idea of the Stonehouse, because when I was thinking about your partnership, it helped me a bit. I once built a wall with natural stones, and to build a wall with natural stones is a tricky thing because you really have to make sure to turn around every stone that it fits in a certain way, and then you can build like a real wall. Does this kind of like turning around every stone till it fits also describe your process a bit?
That's a very good way of thinking about it. It's something Raphi and I never really thought. We don't think about our name too much, actually. We're more just focused on, the investments and generating, compounding over here. So the name really, we never gave it too much thought. But if I had to think about it, Raphi and I, we do part of our process is, turning over a tremendous amount of stones. I think that one of our favorite, this can get into our investment process a little bit, but turning over a lot of stones, but not doing very much in terms of trading, is kind of a key pillar of our investment philosophy. And I think it goes back, one of the key, I think, insights and articles that has kind of shaped our process over time has been the Munger's Art of Stock Picking speech. And that to us, at the in there, he talks about, you just have to keep working and working and working, and hope eventually to have a few insights and find an idea that, or a situation where the odds are just tremendously in your favor. And then when you find those, you bet heavy, and other times you just do nothing in terms of trading. Raphi, what would you say?
Yeah, it's interesting. Especially at the top of the funnel, we say, to us, a great idea can come from anywhere. To us, it doesn't require, saying only can come from somebody with an MBA or some specialty. To us, listening to my sister-in-law has been helpful over time in understanding consumer preferences, and not that she's saying it in terms of investing, just in terms of her own preferences, and that can drive, a research process. So we purposely keep the top of the funnel extraordinarily wide, because we really believe you got to keep, you don't limit yourself at that level. But as Mark said, we are very aware that we only think over time will have, we don't think we're going to be able to act frequently. Therefore, we really need to dig deep and understand, kind of situations we fully understand to believe we have the probabilities correct to, make the kind of concentrated investments we like to make. And that goes, as Mark said, to the Munger's Art of Stock Picking, because it goes to the idea that, like, just because something's the best company doesn't make it the best stock. And that's something that sometimes people lose sight of over time. So we're really in the ideal situation, looking for situations, not that we just understand, but we can really see that there's a change happening oftentimes at the company that is often qualitative, and we believe will show up, down the road in the numbers and the free cash flow per share generation over time. And the market, because it's more focused on near term dynamics, is missing. And those are the situations that kind of we like to turn over a lot of stones to look for that kind of very specific dynamic that can, like, drive, for us, an exceptional outcome, because we think the probabilities are not correctly assessed by the market.
Before we go into the analysis of business and your investment process, maybe let's go a bit in your business history, the business history of the partnership Stonehouse Partners. Mark, you've started to build the firm in 2010. What have you done before, and what was the reason to start a project on your own?
Yeah. So, I've always, I think since I was even before high school, I was interested in the market, interested in business. I think sometime in high school, I was turned on to the Buffett letters, which is where I know many people start their journey. And that really resonated with me. A lot of the stuff that was written in there, to the extent even today, I think about compounding. Every day I walk into the office, it's the first thing I see behind me is a chart of what compounding does to a dollar over many years at different rates of return. And it's really the first thing that we look at, or that I look at every day when I walk in, just to maintain that focus on the long-term power of compounding, which I don't think people, when they're starting out, really have an appreciation for. So I would say, then I obviously went to college. I studied business undergrad at Wharton. I think a lot of people, when they, I was kind of in that mode of coming out and getting a job either in banking or consulting. And I did banking actually my junior summer in college. I was in a group that kind of serviced the big private equity shops. And we were, building LBO models and having all these inputs given to us to put in there. And what I realized then, and I had an inkling it earlier on, was I really love to be more focused on finding the inputs and through hard work and research and kind of getting out there, figuring out the inputs and the key variables that are going to make an investment work, be good or not, instead of being given the inputs and building the model that way. And I was always fascinated with public markets, just the opportunities that I have seen out there over so many years. I just, it's hard to think of any place where there's greater opportunity than the public markets to compound capital. And but that takes obviously the right temperament, and you have to have that. And I just prefer that to a situation I was in where every deal was negotiated, and maybe financing was stapled to the deal, and whoever had the lowest cost of capital was gonna win that deal. I was more interested in digging and doing research on my own. I was lucky enough to come out of college and get a job at a long short fund in New York called Force Capital. And everyone who starts, first day on the job, you think you're going to get this Bloomberg terminal and access to all this sell side research, and really, it was actually the exact opposite for me. My boss, I learned a tremendous amount from him, came out and gave me a corporate card and basically said, I don't want you in the office. I want you out doing field research and coming up with insights, visiting companies. You're not getting a Bloomberg. I don't want you talking to anyone on the sell side. I want you to come up and kind of do this on your own and come up with your own opinions. And I learned a tremendous amount when the years I was at Force. One of the, some of the, what was very valuable there was he was so focused on us keeping digging to get insights, and whether it was cold calling former CEOs of companies on the phone and trying to get insights from them into industries, or just getting out on the road and visiting private companies that compete. I think getting started at Stonehouse really goes back to one of the first companies that I researched when I was at Force. It was a company called Copart, and it was kind of the summer, fall of 2004. And this was a company that is in the auto salvage auction business, which, as many of your listeners might know, if you get into a car accident, God forbid, and the car is deemed a total loss, more often than not, it ends up at one of these salvage yards where it gets auctioned off on behalf of the insurance companies. And I just, found this business to be very fascinating. I traveled around the country visiting mom and pop salvage auctions to gain insight into the business. And eventually I went out because Copart was a company and we were researching it intensely. It didn't need capital. It never came to New York on any sort of roadshow. They were not promotional. To really get an insight, I went out to the annual meeting of stockholders, which almost no one attends, obviously uncontested. And I went up to the founder, CEO at the time. This is the fall of 2004. His name is Willis Johnson. And he really spent the next several hours with me, teaching me about the business, his history. And funny enough, when I first approached him, he said, "Oh, are you that banker from New York who was visiting all my competitors?" Because they had called, he's been in contact with every player in the industry for decades. Eventually, they would sell out to him, given that he was the leading consolidator and best operator. And, we hit it off and ended up owning Copart at my old fund. It was, I think in the fall of 2004, it was a $2 stock. Now it's in the mid 60s. So it's been an exceptional business, but I learned a lot about business, understanding unit economics, return on investment, and really, what I really ingrained in me there is ability to partner with exceptional business operators and exceptional people in the public markets at the click of a button. Anyone could do it. And so, ever since then and earlier, but, I would say that has been, really pivotal in starting Stonehouse, not to mention, when I got the idea to leave Force eventually, after a wonderful experience there. And what everyone does when they start a fund, they write down on a yellow pad, like I have in front of me today, everyone that they could possibly go hit up for investment. And Willis ended up being, at the top of my list. I flew out to California to see him, and he was day one investor in the partnership. So that's, just incredibly lucky how that happens. And that's how we got started here.
Are you planning to travel abroad during the next weeks or months? Then please check out the service of Wise. They offer inexpensive credit cards and very good FX exchange rates. So if you want to pay locally with dollars, euros, or Swiss francs or any other currency, Wise has a big repertoire of currencies, their solution might be an interesting option to consider. You can also store foreign currencies in their accounts. And what else you can do, you can find via the link below. Please check it out and support if you create an account Good Investing. And now, without further ado, enjoy our video. You've been running Stonehouse from 2010 to 2017 alone. Have there been any phases, looking back, you could describe in building an investment firm, or how would you describe these years?
Yeah, I mean, over 13 years, you try a lot of different things. You kind of figure out when we've had a stint of activism in this fund where we went publicly activist on a company that was way back in 2013, but it really taught me a lot of things about investing in public markets and running a partnership. I would say that's something that I've since shied away from, and principally because it taught me a lot about liquidity. I think that, at the end of the day, you want to be able to change your mind if the facts change. And I'll let Raphi jump into that because he's also been instrumental in our thinking on this.
I think Mark and I talk a lot about, even though we run a concentrated approach, there's the technical liquidity, which we are focused on because we do believe, you have to be able to change your mind in this business. Facts do change sometimes, and you need to make sure there's the ability just from the daily volume of any given security that if we needed to change our mind and exit, that we would have the wherewithal to do so. And that factors in to how we think about what we're going to invest in. And I wasn't around at Stonehouse when Mark did his stint to activism, but obviously at that point, Mark obviously had limited liquidity primarily because he was had a board representation. And I think Mark has changed his view that ultimately working constructively with management is a very good thing. But if it gets to the point of going activist and you have to limit yourself with that board representation, ultimately is not the healthiest thing for us in terms of having the ability to shift capital and change our mind. We also now, over the last 12 months, we've talked a lot about kind of this idea of mental liquidity, because I think a lot of people, it seems like to us, and we are hyper aware of it ourselves, have kind of, because they're so public in their names and they're so talk about them so frequently, that it seems to us, even when the facts do change, they don't actually change their mind, primarily because they've told so many people that this is, a great investment, or they told their partners or whatever it is, that they get so trapped mentally in a name that they're not able to change their mind. And we think that's also a very dangerous thing in this business, because, we do think the ability to change your mind is critical as facts, as your hypothesis. You have an hypothesis, and if the facts, start refuting that hypothesis, you have to be able to sell. And so we talk about that a lot internally, because we think it's absolutely critical for us to be able to operate in a way where we can be concentrated, but also be able to recognize where we might be wrong, and therefore not say, well, we told all these people this is such a great investment, therefore we can't sell. We're kind of become more hyper aware of that over the last 12 months.
Mark, if you could go back to 2010 and meet your younger self and tell him some things about how to build an investment business, what would you tell him and advise him to better build an investment business?
Yeah, I think, something that I did when I was starting out, obviously you write down all the people that you could approach and try and get investment from. I had no track record of my own at Force. It was a one book run by the portfolio manager there. And I was just a research analyst. But I think, everyone is willing to take a meeting for an idea. If you're, funds are, popping up every day and you want to get meetings with people. I think what I did, I created a deck on a singular idea, and I cold emailed a bunch of fund managers who I thought would be interested, or people that had the ability to invest. And I said, look, I have this idea I want to share with you. This will show you some of the type of work that I do. It's also an actionable idea. I'm not going to make you sign an NDA, but I just trying to get your foot in the door, trying to get meetings. Almost everyone will take a meeting for an investment idea. And so that I think is primary, in terms of just getting your foot in the door. I know Raphi had a similar experience when he was getting into investing prior to joining Stonehouse. And then I think, finding the right LPs. I think that is, and you find them, by reaching out to them and contacting them, especially with a great well thought out investment thesis. I think that is hugely important in knowing who you are as an investor, the type of fund you want to build, and starting out with the right capital base that will allow you to invest the way that makes sense to you. I think a lot of people know what makes sense, but are kind of trapped into a certain bucket of type of fund that they have to have, that makes it not, totally makes, keep everything aligned. Raphi, what would you say?
Yeah, I think it's. I think this is a business of ideas, and I met Mark through a mutual friend in 2010, actually. But the reason I joined Stonehouse was because I had an idea. It was actually a short idea in a company I believe was committing accounting fraud, and I believe it was about to break because of an auditor change that was forced upon the company, and that the new auditor was going to ding the company when they had to file their annual report. And so, a friend who introduced me to Mark in 2010 actually told me to go reconnect with Mark in 2016 to see if Stonehouse would scale the idea. And it goes to the idea that when you have a great idea in this business, people will listen to you, because that's what this business is about. This is a business of ideas and proving out your ideas, and then investing the capital based on on assessing the quality of those ideas. So I think for me, I wouldn't have be able to join Stonehouse, and it's been now 5+ years, unless it came from an idea I had on the short side. Ironically, because that's not really Stonehouse's MO, but it was from through that idea that Mark decided to make me a job offer.
I think Rappi's being modest. He came to see me. I think it was we got together in December of 2016,
16.
and I think in the first few months of 2017, the stock was down 50%. I had it on my watch list, and I said, Raphi, why don't you just come sit in the office? We'll figure something out. I had extra space, and so now we're more than 5 years later. It's been a great partnership.
Raphi, you worked before you joined Stonehouse at the New York Times, which is not like the worst address for journalism. What made you then even decide to go for investing as a full-time job and switch careers?
Yeah, so I was actually a lawyer when I first met Mark. We were connected. I was a lawyer at a law firm called Ropes and Gray in New York in 2010, and then so in 2016 I was working at the New York Times as a researcher for a columnist named Maureen Dowd. And as I was saying, that was a period of time I had this short idea that I wanted to run with. And so, I caught the investment bug in law school. So I was later in life. And I had a great, amazing law school experience and a wonderful time at the law firm. But I did know I wanted to shift eventually to investment. So I was able to kind of, after leaving the law firm, kind of do my own investing for a period of time. But this special idea I had, I really wanted to scale, and that's kind of forced, kind of me to go to Mark to see if we can make it bigger. But it was kind of like truthfully a self-taught love affair with investing that kind of drove me to where I'm at today. It was not, through formal education, but that goes to the idea. Also, I think that my view on investing is great. And, learning investing, obviously you can do it in a very formal approach, but I also think it could be, self-taught, because I think the concepts are very learnable, and obviously they're hard to apply. I mean, it's a very hard thing to apply, but the concepts themselves are, anybody I believe can learn about investing, no matter what their current career is.
What kind of journalistic or law lens have you still on when you do investing, and that others have don't have this background?
I think what has helped me, it's interesting. So the research process at the Times, I think I was working for Maureen Dowd, as I said, and what she taught me is, because she's been an exceptional journalist and now opinion columnist for many years. I mean, she started at the New York Times in the early '80s. She's been around for a long time, and she taught me, in the end of the day, what we are storytellers, right? She's a storyteller, and not that she invests, but she finds, she's throughout her career wrote amazing stories about different people and oftentimes politicians. And when we invest, what we really do, when Mark and I get into our research process, what we're really doing is writing, in our view, kind of a magazine story. And obviously, at the end of the day, if we're going to invest, then we put the money down on it. But ultimately, our process involves not much different than the journalistic enterprise of saying, what is this company? What do they do? Who are the people? What are the drivers of future returns? And write it, and kind of be able to, as if we were going to just write it out into a story for people to digest and read and understand. And I think the legal side is obviously just a lot. When you're learning the law and then practicing it, even though I was a short period of time I was practicing, obviously you really have to, your reading comprehension has to go up by a large factor to be successful in law school and at a law firm. And I think it just kind of that educational process of understanding logic and reasoning and improving your reading comprehension is always beneficial. I think the benefit for me, it's interesting, is I think by not going through kind of the more normal banking or kind of MBA path, which is perfectly fine place to obviously start your career and go through, I think I probably came with a little different mindset and a little less preconceived notions of what makes a great investment. And I think that over time has, helped me in my own unique way, being a little bit different than other people. I think by not having such a formal approach, growing up with investing, I think I might come at it a little differently. I think that's helpful for anybody. I think everybody's got their own path, and I think it's helpful for people to recognize that their own path can be, helpful in the sense that you don't, you want to, obviously you're not gonna, the concepts are often the same, but you don't want to think like everybody else. And sometimes by not, being in the same class kind of process as everybody else, it helps you kind of see the world a little differently.
How has Stonehouse process changed since you joined the firm?
I think Mark would say I've been helpful having a little more cynical approach to push back against certain ideas, to have a good sounding board, to knowing that I look at things a little more cynically than Mark often. And so, especially over the last number of years, there's been a lot of things we've studied very intensely, some names that were part of kind of, some of these, the era of certain stocks that were going up but not making any money, and kind of making sure, like, that just because something's a good story, that, like, we have to, like, do we actually understand the unit economics? Do we, do we just, are we, making sure we're not falling prey to kind of the groupthink mentality that can overrun some of these type of situations. I think Marcus, yeah.
I think Raphi's touching on one of the key things that we have to guard against, is, over the last several years, is FOMO, frankly, and fear of missing out on, we look at a lot of companies, as we mentioned, getting back to the stones, we turn over a lot of stones, and you have to be comfortable in this business. I think allowing and being happy for and clapping for other people that you may know, or other people out there in the market who are making money on stocks that you've frankly looked at and researched and gone through your process. You just can't get there. Maybe people are falling in love with revenue growth, but not really thinking about long-term unit economics. And the stocks are working for periods of time, but at the end of the day, we really have to maintain, and it's very difficult at times, frankly, is protecting against FOMO. But it's been great, Raphi and I think we have a very good way of thinking about that, and just being happy for others who can make money in things we don't understand.
Maybe let me add, before we jump into investment philosophy, a partnership question in your partnership. What are three strengths you like about the other has, or three strengths the other has you like?
I think Raphi, he's a very, as he mentioned, he's a very fast reader. He consumes a lot of information quickly and is able to distill it down to key concepts. He pulls out, I think, kind of key variables that are going to, what we try and do is, consume a lot of information and understand all the different information out there that we can gather, but really distilling down an investment to a few variables is what we do. And I think how it makes sense to us. There's so much noise out there and so much data you can collect, but for the way we invest, distilling down investments to a few key insights or variables that are going to make or break is important. I think Raphi is able to identify those very quickly. And I would say third, he's a very, very hard worker. It's hard to, I think, what I've really been so lucky actually to have Raphi on board. This is a fund that I started, and kind of, you're the founder of a fund. Raphi is not the founder, but I would say he works as hard as a founder, and is kind of, this job is a 24/7 job, and he's kind of shown that to me, that he is all in on this as much as I am, even though I started the firm.
Yeah, with Mark, I think there's Mark has a tremendous amount of strengths. I think anybody who's in this industry and has been doing it for 13 years, I think that, there's something, this is a very difficult business the survival rate's not very high. I think there's a lot of reasons Stonehouse has been around for 13 years, but I actually think the number one thing. Well, I guess I'll combine a number of things together, but basically, Mark has the exact right temperament for being a portfolio manager. We run a concentrated strategy that means there is going to be volatility. You cannot avoid it. I mean, it's not possible given when you run a concentrated approach. And in order to run that successfully and compound money at a very high rate over time, you need to be emotionally able to handle it. And Mark has demonstrated to me over and over again since I started working for him that he has that emotional wherewithal to withstand the volatility, understand that you cannot use if you're a forced seller at the wrong time, it can destroy years of hard work. So we don't just just because if the market's just because of we don't just say, well, our stock's down, therefore we're 100% sure we're right, and the market's not wrong. But it's more like you also can't allow that emotion to just force you to sell just because you can't take it anymore. And Mark, is really demonstrated that over and over again. And I think Mark is incredibly strong in the sense that he knows what he knows and he knows what he doesn't know. This is a business with a lot of big egos. A lot of people have a lot of success and then think that they know everything about everything or think they have to be the smartest person in the room. And Mark, I think, truthfully, is very smart because he knows he doesn't need to be the smartest person in the room always to be successful, that he's an incredibly curious person who wants to compound at a very high rate for as long, as humanly possible. But I think he knows he's able to do that by being a great listener and knowing that he doesn't need to be the smartest person on everything, but there's just a few good insights he needs over a course of years to really generate the returns that Stonehouse has been able to generate. And I think it's kind of that combination with a great foundation that allows it has allowed Stonehouse to be successful, truthfully, because I think there's a lot of people in this business who are obviously some of the smartest people around, but a lot of times they either don't have the right temperament or their ego gets so big that they start allowing themselves to think they can know more than they actually know.
Do you look for an investing community? Then Good Investing Plus might be the place for you. Here you can make friends with other investors, get feedback on your ideas, and learn and grow. If you're interested in Good Investing Plus, please click on the link below. I'm looking forward to your application. How do you filter out what really matters in the consumption of information? Sometimes there's this picture used of noise and really real facts.
It's interesting. I have a funny thing with this at this point because I've thought about it a lot because I consume an insane amount of information, and it gives me great pleasure in a sense that even if I wasn't doing this job, that's just the way I am for a long time. I love information. I just love and it's almost like meditative in a weird way for me. I know some people say they need the opposite, they need to turn off the noise, but I actually find myself most relaxed when I'm just kind of over consuming information. So it's kind of a strange thing, I guess, that's just the way I am. I think like anything, I think there's a lot of muscles you develop over time. Like an example, just as a concrete example, something Mark and I focus on a lot is marketing. We think one of the things that people often, I would say miss, but they don't use it as enough of a filter is if a company is spending a significant percentage of revenue on marketing expense, and the idea is that someday that needs to lever, I think people don't put a high enough bar of the odds of that happening. Like it's a very difficult thing for a company to just one day shut off its marketing budget and still grow at a healthy rate. Oftentimes the reason it's growing so fast is obviously just kind of overspending on marketing. And so this idea years later, you'll be able to lever it, we think is something that we often use as a filter to say we can't invest in this company. We just don't feel confident that's going to happen. And the other way we often find investments now where we find any company that's been able, obviously particularly on the consumer side, but it could be enterprise as well, grow without marketing. That to us is a very powerful sign of something that catches our attention from the muscle of saying we got to really look into this company very closely because there's something clearly special going on that has allowed to achieve such success without spending a lot of money on marketing, and the product is clearly resonating. So it's something like those. It's those type of filters that we kind of take in so much, but then have these strong filters that allow us to say, okay, what is actually worth spending real time on beyond the initial kind of this is interesting.
It's interesting, Raphi. You mentioned consuming information, but one of the things that we actually don't do as a firm, and I think is subscribe to all sorts of credit card data and try and get short term type of data on companies. We think a lot of that would just not play into the way that we invest and even cloud our judgment. Just having too much information based on short-term stuff. Raphi, how would you describe that fact that we don't use that?
Yeah, I think we've determined that credit card data and that any type of hard data like that that's really short term in nature, in our view, would actually hinder our process because ultimately we're obviously making generally long duration investments with the idea of them being long duration. Obviously, they don't always work out that way, and making long term decisions based on, let's say, weekly credit card data sales is not, it doesn't match up to us, and so therefore we think if we, having, I think people have, you have to just decide how you're investing. Obviously, if you're investing based on trying to predict quarters, then you need the credit card data to even like try to do that. But if you're investing on like, a qualitative change in a company that you don't think actually will show up in the numbers for, uh, you know, a year or more, then obviously, weekly or monthly kind of data is not going to help you. So we kind of come to the conclusion, for at least for us, that it would actually hurt us. And we would kind of try to always, as you talk about, we consume a lot, but always be aware of where where you can go wrong. And I think that's something Mark's actually one of the strengths that we were talking about before, Mark, is that he's been around long enough to know where you can go wrong, and therefore we kind of want to avoid that, because the mental side of the business is so challenging. So if we were sitting with one of our companies that we've owned for a while and we're looking constantly at the weekly sales reports, or not sales reports, but the weekly credit card data, it might actually make us so emotional about it that it makes us make strange decisions, versus not, by not knowing it, it helps us kind of keep a more level head.
Mark, how do you cultivate and grow this right temperament of a good portfolio manager?
I think it has to do with, frankly, gathering the right set of LPs, and not trying to be someone who you're not. I know that I'm not someone who can manage a portfolio and not ever be down. These types of things. I know that the kind of firm we want to build for multiple decades is going to be a handful of concentrated investments at any point in time, and you're going to have that sort of volatility. And when you take on partners who might be expecting something else because they've seen a track record of returns that they want to get involved in, that is, to me, the kiss of death. I think you have to be at all times, upfront about your process. It's not going to, and your investment process is not going to resonate with everyone, and it's not for everyone. But the select people that have found us over time, either through referral or for word of mouth, have been the right people, and that, to me, because we've had periods in the fund where there has been quite volatile and drawdowns, and we've been able to recover from all that, from all those episodes. And I think a lot of it has to do with not having the outside pressure of something that you promised to someone that is never going to happen, and then it happens, and all of a sudden things go haywire. This is part of investing in Stonehouse. It's not going to be a straight line. It's going to be a bumpy line, but hopefully over many decades, it's going to pay off handsomely. Raphi, what would you add to that?
Yeah, I don't think there's much else to add. I think it's having the right partners, having the right foundation, understanding what we're looking for, building those muscles. It really does, like, just like the money compounds, that compounds itself over time. I think, it's really, we're trying to achieve a certain set of we're trying to achieve a certain thing, and having the right people along for the ride is critical, because if it wasn't, then it would just, during one of these more volatile periods, and we would have to invest a different way, and that would ultimately cause problems, for our long-term returns.
So, as business builders, you don't look for growth of its in its sake that it's growing, but for the right kind of growth, so to say.
Absolutely. I mean, Rafi and I think about this all the time. That if we have the partners we have, and we don't raise another dollar in the fund, and we compound this at this compounding chart, it's really quite powerful. But over the next several decades, if we can keep up solid returns, we don't have to raise any more money. It'll be a great career. We I think that's what is the big insight. And I think once you unshackle yourself from fitting into a certain box that has to please all sorts of different groups, the real light bulb goes off, and you can start thinking in terms of producing longer term exceptional results for people.
Let us jump to a bit more business analysis, investment philosophy. What are important metrics that you look for in an investment?
So, at the base, well, obviously what we are trying to do is judge, the future free cash flow per share of a business. And then obviously, in our process, as I said, the top of the funnel, we keep wide open. But then once we get to something where we think we understand the business, understand like how it works and kind of the basics, kind of building blocks that you're looking for, if like, why the returns on invested capital is sustainable, why can this business generate, real wealth for shareholders over time. We then often we go into a kind of a checklist approach process where the thing we're really, really looking for is, as Mark said, the art of stock picking, something Mark refers to a lot, in that we want to just say, okay, we figured out this is a great business, but why is it not obviously, valued in a way that's already reflected that, and therefore why are the forward returns not so exceptional? So what we really look for when we get into that kind of checklist process is we often find our best ideas are involve a situation where there's some type of change happening at the company or in the industry. Oftentimes that changes people, frankly, but it's usually some form of qualitative change happening that we can assess in a realistic manner. And then what we like to see, because goes to the how high a bar we're looking for, we kind of find these change situations that we believe will drive, a much higher rate of future free cash flow per share than the market is estimating in our view. But it will take often times to develop. But we find management teams that have kind of what we've come to term a per share obsession. Because oftentimes, if you don't combine the two, the results can't be exceptional. Because oftentimes people, management teams are not per share obsessed. They know how to build a business, but then they, will over time, create through dilution or other means, harm your forward return. So we kind of look for those two things in combination, where there's some, change that we don't think the market's pricing incorrectly, and a management team that really gets that their shares are, that they have a long-term per share obsession, and oftentimes recognize that their stock might be undervalued based on that change, and either is repurchasing the shares ahead of that change, or just has enough recognition of how powerful the future is for the business, and then that they want to make sure the per share value is preserved.
About in your framework, how do you think about debt? Like, I personally tend to avoid debt in companies. How do you think about it?
That, I think, it's a tool like any other. I mean, it's something that I think, obviously too much of it going into a bad period can kill you. So we're very aware of that. But from a standpoint of only invest in unlevered businesses, I think that's not one of our checklists. I think it's not something that we'll always stay away from as a litmus test. Raphi, what would you say?
Yeah, I think it's something to consider. Obviously, we don't shy away from companies, obviously, that have debt on their balance sheet, but we think from our perspective, it's really an assessing the management's ability to understand how to manage your balance sheet correctly. And that means that certain companies obviously should have debt and don't, and therefore that's actually a knock on the business. Reason why we won't invest, actually, truthfully, that business is clearly overcapitalized, and the management team, for whatever reason, culturally or other reasons, is actually not per share obsessed, and therefore they're actually not optimizing the business for shareholders. Obviously, you see that a lot in tech world, where you have extraordinary businesses, but the balance sheets are kind of clearly hoarding way too much capital. And then obviously on the other side, you got to be careful that that you're not obviously in a situation that obviously nobody calling macroeconomic swings is very difficult, and obviously you want to make sure the business can, even if it has debt, has the ability to pass that, get past any storm. So it's something we're very obviously aware of, but we look at it as kind of, when we assess the situation, we kind of assess also management's ability to understand how their balance sheet should be run over within reason. And I think it's hard to say without being specific about any specific company, but I think it's not something obviously we look at as a negative just because a company has debt.
You run a very concentrated book, and this with success. I think the recent performance I saw, it was like in the around 20% per annum compounding you did with Stonehouse Capital Partners. Congrats to this. But with this very concentrated book that's even below, I think, 5 stocks you own, how do you make sure that you don't look stupid or don't make a mistake with the investments you do?
How do we make sure? I mean, I think concentration to us is more of an output of our process than an input. I mean, we don't come into the office and say we have to own a certain number of stocks. I think, Raphi and I are completely invested in the fund. We're the largest investors, and obviously we want to compound our capital at the highest rate within reason, prudently reasonable. I think that it comes back to staying within our circle of competence, thinking about the businesses, not necessarily the stocks, the businesses that we own, the underlying free cash flow that we're kind of owning as an owner of these shares. Um, and in terms of looking stupid, I mean, that's something that you just have to be prepared for in business. I mean, you have to be willing to look stupid, frankly, for periods of time. And that, I think, is what separates your ability to make returns and missing out on huge winners. We talked about FOMO earlier. You can look pretty stupid for periods of time in this business, but at the end of the day, through your research and building conviction over time, I think there's nothing that there's nothing like going out, visiting businesses, kicking the tires, touring the facilities, meeting management, different levels of management, not just your corporate CEO, but go all the way down, head of product, head of sales, all the way down the chain, and gaining that type of conviction in an investment. That's the way we invest, and we almost think like private owners many times of businesses when we buy something. We basically don't think about where it's going to trade in the short term. We're looking out, 3 to 5 years, typically when we underwrite something. Raphi, what would you say about looking stupid?
Yeah, no, I mean it's going to happen, and anybody running a more concentrated approach it has to be, you're not going to be right all the time. I think goes the idea we need. That's why liquidity, mental and technical liquidity, is absolutely paramount for us because we have to be able to change our mind if the facts change, and we have to be, and then be able to change your mind. You have to be able to sell, and therefore, that is something we think about a tremendous amount. So the ability to have liquidity allows you to be wrong and move on to the next idea. It's very important, and that because the way I think you can go wrong in a lot of ways in this business. But one way is obviously running a concentrated illiquid portfolio means that you can't ever be wrong, and our portfolio is concentrated but liquid.
Mark, you already mentioned a bit the stones you turn around people. Can you maybe give some more light? Because like in your philosophy or in your approach, you look for change, and usually it comes with people, or often it comes with people. What kind of stones are you turning around to make sure that the change is going in the right direction and that you're investing alongside the right kind of people?
Yeah, I think at the end of the day, you can. Raph and I talk about often, expert networks, transcripts, things like that. I think that's kind of table stakes at this point. And oftentimes, if we see too many transcripts popping up on a certain company or doing research on that, it's sometimes honestly a red flag to us because it just means people are searching for reasons, to try and confirm why they might be right about something. For us, it's trying to get a real insight into people. What I've come to realize is that after doing this, in Stonehouse for 13 years, and then prior to that, for a couple of years at Force, everyone can sell a good story. You don't get to the top of a company without being a good salesman. Generally, you've played politically, you've played well, you've been able to step up the ladder, and you're charismatic. So at the end of the day, we really have to judge people by their actions and not a story they're telling or or because they're charismatic. So it's actions, it's results, it's do we understand decisions they made at different times in their career, at prior experiences, and it really comes down to are you judged on results or what they're telling you they're going to do, with X, Y, and Z. Raphi, what would you say?
Yeah, I think it's like, people, as Mark said, people, when you rise up at a company, oftentimes you're a good salesman. So we have to, it's really the actions of the people and their histories and decisions they make, we judge them by more than, how they sound, because oftentimes the smoothest sounding person can often be, not, obviously good at kind of BSing you. So it's really, we judge people more by their actions historically and understanding their decisions versus, just saying, well, they sound good, so that means they're are going to do the right thing. Because there's also examples where you have to be careful because there's some company managements that talk very good game on particularly around capital allocation, but it becomes almost its own marketing thing for the company versus actually, creating wealth for people. It's a very strange situation sometimes where that's the sale pitch, and it's not, but not because of their actual decision. So we try to judge people by their decisions. I think and it goes back to the idea of like, while we go deep into a company, we think, if things aren't obvious at a certain point, and if you have to like adjust your model a little bit this way, I mean, obviously that means there's something that you're just not, it's just not there. You can't get that level of precision. And I think I saw something funny that somebody said recently that I thought was so insightful, that they were saying, the old man in Omaha outperformed all the TMT funds over the last number of years by buying the one stock they all hated, and that being, Warren Buffett buying Apple stock. And I think you learn so much from Warren Buffett, obviously by his writings, but also his actions. And in the case of Apple, when we look, it's funny to think about that, because it was just such a simple idea of what he saw as like a sticky consumer product company that was, at that point, at least when he was buying, probably trading more like a cyclical hardware company. And it took that, it wasn't because he had the best, the most transcripts or the best data. It was just kind of a simple understanding of the power of the business. And then obviously, through Tim Cook showing that he's, compared why didn't he buy Google or other ones, I think it's because Tim Cook showed he was so shareholder friendly. He runs his balance sheet much different than other tech company runs their balance sheet in terms of thinking about per share value. So that when I saw that really resonated with me, because it just goes to the idea of, what we're saying is that, the simple, powerful ideas and the per share obsession can drive a lot of returns, and trying to over complexify everything can make, and thinking that if you read another expert network transcript, that will give you the answer. It's often case the opposite.
You guys seem to look for very deep insights in stocks that not many others cover or invest in. But like, you already gave this example of the Copart CEO you were talking to, Mark, and you did all this work to talk to competitors and get some insight, also like to get this deep insight. And like, if you think about investing as a relationship business, relationships and trust form over time. And this is also the foundation to get this deep insights. How do you think about this time you need to invest to get deep insights, and also the time you need to build trust and the relationships for these deep insights?
Yeah, I think, building trust. I mean, I think that's most primarily with your LP base. I think that's essential in this business. I think, I'm not spending our time building trust with companies that we're going to invest in, because, we while we do like to go very deep, we do need to we can't make like, oh, I love this person so much I can't sell his stock. That's not something that we ever want to have constrain us. But in terms of, building trust, as you mentioned, Tillman, I think what's been so helpful to us, in periods of time, our investors over, long periods of time, and going through different episodes of volatility and drawdowns, and coming out of them, and having this track record, I think they've developed trust with us, and have added during periods of time when it makes sense. When we, frankly say this is a great time to be adding capital to the fund, and that type of trust is the type of trust we focus on building, because it becomes like a flywheel. Raphi, what would you say about going the other way when we invest in companies?
Yeah, it's interesting. I don't. I guess in terms of like the management, like trusting management, is that? I guess I'm not.
Yeah, to
I
have
apologize. I'm not.
deep insights about the industry, and also information that others don't have, you have to build relationships and be with the ear close to it. And like, people usually in the
Yeah,
first talk, they don't say you all the pitfalls of the game they play, and
yeah,
give you all the
sure.
insights about the dark stories or whatever stories.
I'm not sure we actually have information, in my view at least. I think oftentimes we don't have it. It's not that we have information other people don't have. It's more that we assess it differently. The same information other people have, and that goes to the idea of Mark and I are very focused on not falling prey to groupthink. We often say that oftentimes with investments, it's like people agree with you later, right? It's like they have the same data, but oftentimes your investment turned out to be right because people come around to it later. So it's oftentimes that's the situation. And so it's more that we have we probably rank higher than other people in terms of how we assess cultural things at companies than other people, and therefore when we do our research, we often focus on that to maybe a higher degree than other people do, because obviously the business quality matters, the industry matters. These things are obviously drive a huge amount of the return, but also the people matter so much. And so we kind of just probably rate that higher than other people. And then in terms of assessing it, it's a harder, it's a squishier thing. There's no data on, personality types, right? I mean, this is not like you can just score people and say, oh, they're going to be good. So I think that comes from a combination of muscle, and then also recognizing that, you have to assess them based on what they do and not just what they say, because otherwise you can get trapped into very good sales pitches. So I think that's why, as Mark said, it's more of an output of our process, our concentration, than an input, because finding these handful of situations where, you know, everything lines up and the company has a per share obsession and the culture and all these things that are, a little squishier, all line up in a set way that we really believe we can assess the probabilities correctly of the future free cash flow. It's only a handful of these that you're going to really find. So if we lowered the bar, then we would obviously have more stocks in our portfolio, because at that point you can say this is a good business and a good industry. Who cares about the people that do okay? But to really get to the exceptional outcome, I think we really think you really need a lot of more things to line up. And so I think we smartly, and I think this credit to Mark, is really focusing on the culture at companies, and the people making these decisions helps us have sometimes more insight than other people. We know people have access to the same level of information.
Yeah, I think then Raphi touched on a concept of probabilities. I mean, we're not operating in a world where we're going to have perfect information. I mean, it's not going to happen in public markets. And I think that's something that we like, actually, because we like doing research and we like kind of building these theses, get going, and you start testing them. But you're never going to have the perfect information. So you're constantly feeding, different information, trying to ascertain these key variables, and then weighing kind of probabilities against price. Frankly, probabilities of different outcome against price, and building conviction around why these are have an exceptional skew. These handful of ideas that we own at any point in time.
In your toolbox of working with companies, you don't use the concept of the loud activism anymore, but you really want to have companies that are shareholder friendly, and sometimes management are just humans and they don't see all the things, and you as a shareholder see things management doesn't see. How do you bring this on the table, and how do you make sure that there's a certain shareholder friendly influencing and not activism happening?
I think, at the end of the day, Raphi said, I think earlier in this interview, I think he said that, we know what we know, and we kind of try and stay away from what we don't know. At the end of the day, Raphi and I have never run a company, unless you can call Stonehouse a company. We are not business operators. I think what we do is try and, when we interview management and talk to them, we try and understand why they did certain things, why this, why that, and keep asking why. And you can understand how someone thinks, and then you can judge how they operate businesses or previous episodes in their career, how well, how the results have turned out. But we never claim to have any sort of insight or edge in trying to manage a business. I mean, we're not going to come up with a great idea ourselves in terms of managing a business. We want to kind of find these special entrepreneurs, and if they're not the founding entrepreneur, they act like one when they're running the company, and think about it as if it was their own. I think that where we can add some value is kind of behind the scenes, kind of showing them some math on if X, Y, and Z happens, as you think it might be in your long-term plan that you've released publicly, and you think this is what your 5-year plan in terms of what you think you can do with this company happens, and you do this with your capital allocation strategy, you know what? Your stock at the end of the day is going to be worth twice as much as it would if you did something else. And either that resonates with people or it doesn't. And frankly, we want to be invested alongside, these great business operators who also can wear the hat of great capital allocator. And I think that it's so important to think about, because your outcomes can be so different. Raphi, what would you add to that?
Yeah, no, I think, I think Mark has, I think Mark's personality lends itself to very good constructivism, because companies do realize, especially when you become a long-term shareholder, that, that Mark does have some insights into capital allocation and understanding, in terms of like what, how to think about whether or not your stock currently is undervalued or not, and how to take advantage of that. So I think it's funny. There's a letter from, I believe it was 1984, a shareholder letter Warren Buffett wrote, where he talks about obviously the mechanical aspect of repurchase programs being, if you're, it can create a lot of wealth for people if if you're able to, repurchase your shares when they're undervalued. It's a very attractive way to build wealth. But he also makes the point that it also companies that management teams that aren't willing to repurchase their shares when they're clearly undervalued are also showing your hand the other way, which means they're just interested in other things, right? It's like they're not doing the obvious thing. So, it's funny to think about for us as we talk about the people and the decisions they make. When we're assessing a situation and we talk about the per share obsession, if we're talking to a management of a company and they're capitalized in a way and also generate free cash flow in a way that they could repurchase their shares and we believe their stock's undervalued because of different things happening and they do, but they won't do it, then that's probably a sign, we're never going to be activists in that situation, but that's just a sign that they're not, able to make, the decisions that make sense to us. And therefore we're obviously not aligned with the right people. And it obviously goes the other way too. When you talk to a management team that might not have that in their toolkit because it's just not something they grew up understanding or not grew up, there's not just, they're business people running businesses. They're not thinking about capital allocation that way. But when you talk to them and then you explain it to them and then the light bulb goes off in their head and they realize that this is how big of an opportunity is to take advantage of the current situation, given the things they're doing on the business side, that to us is obviously a great sign the other way. Wow, this is like, the market hasn't picked up that how shareholder friendly this management team is. They recognize the things they're doing in business are going to have big impacts on the future operating results, and they're willing to buy back shares ahead of all these changes. That to us is a powerful indicator the other way. So I think we're very willing, and Mark particularly is very willing to work constructively with management to help them understand this stuff. But it's also a helpful way for us to assess, assess their, kind of like willingness to be good stewards of capital over time, and therefore whether or not it makes sense for us to, be invested.
Can you tell us a bit more about like how you, Mark, or maybe Raphi as an observer, like how you work with management in this sense?
Yeah, I think it comes with time. I think everything you can't just happen overnight, but I think over time you can. We've made presentations to boards, we've written letters, and we've had different meetings about capital allocation at our portfolio companies. And at the end of the day, it's just that. I mean, it's literally presenting our ideas. We're not coming up with any sort of operating plan that's so far out from what this management team thinks they can do, given all the stuff they release publicly to investors. It's just a couple variables around the edge that can make a big difference, and that's really it. It's and you kind of can see pretty quickly whether their light bulb goes off, because we do want to invest a long time alongside aligned, owners of shares themselves, who have a significant portion of their net worth in the investment, because we're so concentrated and we have our net worth in the fund. Any investment we're making, we're putting a significant portion of our net worth into the investment. We want to be aligned with people who have the same, obviously. So if they can't see pretty clearly how it could be enhanced or through some suggestions, maybe it's not the right team to be backing. Maybe they're kind of marching to a beat of a different drummer, or they don't really believe kind of the projections that they put out to investors over time. Raphi, what would you say there?
Yeah, no, I think it's just a good, way. Truthfully, it's a good way. I guess you can argue, and you asked me before about like where kind of like our information edge comes from. In those situations, we truthfully might be able to gain an edge over other investors, where we're able to like be in a situation where we can, be in their room explaining some concept to management, and the management just it's not that they can't disagree with us, because obviously, that's actually not necessarily a bad thing. I mean, the mission should be like, oh, you're right. But if you see that they're just don't have the kind of the per share obsession, then it's just like, why are we bothering with this investment? I mean, it might be fine, but is it really are the odds of it being extraordinary? Because it just goes to the idea that public markets are a funny thing. Companies, the way they get built over time, are always so interesting to study. And, there's nothing wrong with investing in a company that's probably more bureaucratic, in its nature. But ultimately, Mark and I, funny enough, used to have kind of I believe, a watch list. I forgot what it was. It was just to us an interesting kind of metric. What was it again, Mark? It was kind of like
The crazies.
the crazies. It was like kind of these very unique companies run by individuals who, people either think are amazing or think are, nuts in a bad way. So, it's not that we necessarily only want to invest in those situations, but it goes to the idea that you want to, to really find, in our view, exceptional investments. It often requires a culture of entrepreneurialism at companies that, people want to truly achieve great things. Because oftentimes you're at a company where everything's fine, everybody can keep their job and get their nice salary, and they don't have to try that hard. And that's not necessarily the worst thing. It's just not, for us, going to be probably the best investment. And therefore, there might be a good investment for somebody who's like, because of whatever reason, it might be a short-term good investment. But for us to really create long-term wealth, it's the odds are not the same. I think that's something Mark can talk about, as he learned from Willis Johnson so much at Copart. Obviously he was the first investor in Stonehouse, but also Mark, I think, over his career, and it goes to the idea of people and culture, realized that not only was there, he talks about it to me endlessly because it's just such a powerful example to him, of Copart being an exceptional business, but the people and the culture were just absolutely exceptional. But you couldn't really fully understand that unless you got to know Willis and his team.
In this list of crazies, if you don't have an answer there, it's fine. How do you distinct crazy, bad crazy, and good crazy?
It's a fine line, that's for sure. I don't know, Mark could talk more about it. I don't think we we didn't do an assessment afterwards. It was more just admittedly, if you looked at the list, it would be a lot of obvious people. You can guess who some of them might be, because some of them are quite famous. It was more just the clear examples of public companies where there was very ambitious people running it who were out on what I use this term, kind of on the spectrum of doing things to their own way, and just didn't care about people's perception of them. And so we didn't necessarily say it was good or bad. It was just saying these might be interesting companies to look at because they're clearly doing things quite differently. And oftentimes, truthfully, it goes back to a concept we talked about earlier. Oftentimes those companies, if you look at their marketing spend, were actually quite low because it was this kind of product obsessed type of people who were more obsessed with the product and driving demand through obsession over the product versus driving demand through buying Google ads. And so they fell in that spectrum too. So to us, it was an interesting list in the sense of just thinking about kind of that metric of how crazy is your CEO. It's not, I don't know if that ever made on a checklist exactly, but it's kind of an interesting to think about.
How much time do you give yourself before actually investing? Let maybe put it in the picture again, from the first stone you turn around to the final investment stone you start rolling.
Yeah, I mean, we keep a running watch list of probably 30 or 40 companies that kind of gets sifted. It's like a triage every week. We go through and try and see where we should be spending our time based on price and probabilities that we've done research on companies. And then sometimes something happens. There's some change that, as Raphi mentioned, that we find, and we just have to get ramped up very, very quickly and doing enough work to get us to the place where we'll put money down and say that this does make sense based on the imperfect information that we have. Again, you're always operating in a world of gray. I mean, you're never going to get to a place where, yes, I know I'm buying this today, and I know that the stock is going to be up 5x from here at that point. It's kind of weighing probabilities based on information you have at the time. And sometimes you can gather that information and get there very quickly that this bet makes sense based on the price and where you think it could happen if X, Y, and Z comes out. And sometimes to build conviction around larger positions, it takes years, frankly. Raphi, what would you say?
Yeah, I think it's just the joy of constant research is that you build muscles to the point where you can act quickly, but it's not really that quick because it's just you're kind of built up enough muscles that an industry at this point, you know enough of the people. Now, it doesn't mean, so it really depends on situation. Some situations require us to spend, a long time before we're able to invest. And other times we've just been studying the industry and for a variety of reasons, or studying the company and the people to be able to make that investment quicker. So it does depend on the situation, but I think that the joy of this business is you don't swing a lot, but it doesn't mean you're not practicing every day. And just the practice is just learning every day about different businesses and different people. And it allows you to kind of when the pitch is coming over, that you understand to act quicker than, to act, not quickly because in the sense of like immediate, but not feel like you need to spend the next 12 months, reading every document that's ever been written about the company to make the investment.
Yeah, I mean, if when we build a model on a company, if we have to go out, a certain number of decimal places to say if this is good for us or not, I mean, it's definitely not good for us. Precision in that case is the enemy. I think that it has to kind of click before that that this is something that makes sense to us.
How do you make as two in a partnership make sure that you control and challenge yourself or each other so that you don't come off the road or that you don't make mistakes and run into biases?
Yeah, I think Raphi and I have a very, very good working relationship. I mean, he's probably the first person I speak to in the morning and the last one at night before I go to sleep. And I think we've just developed over time the ability to be very honest with each other. Pointing out things that don't make sense or running into different biases that might be out there. We're constantly kind of shooting this back and forth and having this discussion about stuff.
With your approach, you're looking for change that isn't seen by the market. But if this change gets seen and the positive impacts hit, usually this leads to a certain multiple expansion. With what kind of multiple expansions are you like fine to have in a certain stock? Because it's usually a nice thing that drives returns if the free cash flow multiple goes from 5 to 15 or something like this. Where do you see there's an over expansion for you?
Yeah, I think what Rafi and I, what we constantly, I think back to some recent examples. We're constantly focused on the forward IRR of an investment. We don't kind of underwrite multiple expansion going into an investment. If it happens, that's great. We kind of focus on what is kind of in management control, which is operating the business and kind of what is the obviously free cash flow coming out of the business over time that we can think about. So multiple expansion doesn't go into our thought process. If it happens, that's the double tailwind. But I think, always focusing on the forward IRR. If something it was trading at a certain multiple and now it's trading at twice that multiple, and it comes back to probability also. What's the probability that it's going to go to 3 times the multiple it was trading at previously, and kind of keeping that in mind, and then also keeping in mind everything comes back to thinking things like a private owner of businesses. Like, would you want to hold on to a business if you had full, liquidity if you can suck out this much cash over time and get paid this much today for it versus what we were buying it previously. So it just comes back to that, probabilities, thinking like a private owner, and understanding that the beauty of the public market is you do have liquidity. I think sometimes that's something we need to, obviously investors can get as Raphi talked about, the 2 types of illiquidity that we think about. That's the beautiful thing. Raphi, what would you say?
Yeah, obviously, when we're underwriting we think there's a change happening, and often that change is going to mechanically increase the return on invested capital of the business, and then ultimately, if you go back and do any type of analysis on when that happens, the multiple usually expands if the market believes that's a sustainable change in return on invested capital. So we're not unaware that if things play out as we expect, that the multiple will expand, but we don't underwrite that going in. I think for our sense, as Mark was saying, we got to make sure if we're lucky enough to find situations we invest in where the return on invested capital obviously goes up, and then obviously the multiple expands, that's obviously going to be a very good outcome. But then recognizes like, let's not fall just because we believe, by fall, you don't want to fall in love with the situation to the point where you don't realize the forward IRR is a collapse, because there's been investments Mark and I have worked on together where we are shocked by the quickness of the market to re-rate the company based on something we assessed. And in those situations, you really want to be honest with yourself about what are the realistic forward IRRs, and therefore, you have to be able to sell in those situations. And it's hard. That's, I think some people say in this business, selling is sometimes harder than buying. And I think that, because it's so easy to say, like, oh, you can just fall in love with the management team or the company and say, I know it's a little overvalued now, but I'll keep holding. But I think just being constantly realistic about what reasonable forward expectations are is helpful. And it's funny. We also talk about a lot about. We've been focusing and talking about, I should say, a lot about industries where we don't expect the market to ever get so excited about the business from a multiple perspective, and how that itself can be a powerful thing over time for compounding. Because if our assessment on the quality and duration of the business is correct, then oftentimes management does have this tool where they can, be constantly repurchasing their shares at attractive valuations. And because obviously one of the problems obviously companies run into is that eventually, if they're generating a lot of cash and their stock's trading at a very high multiple, what do you do with all that capital? But there's certain industries actually, if you look back historically, where the multiple has stayed very reasonable, and management recognized that they're just in a very good business and have just basically retired a significant amount of their shares over a long period of time. So it's interesting to think about. So obviously we just always want to honestly assess the situation and be honest about the forward IRRs, because it's very easy to just fall in love with your name and just say, I don't have to sell it, even though things going forward are not going to be as good.
Aside of the forward IRR, why do you sell? What are other reasons?
I think if you write down your reason for owning something, and that's changed. Like for example, if you are believe that a new management team has come into a company and they can do X, Y, and Z, or some sort of change that Raphi mentioned. A lot of what we do revolves around change that's not kind of recognized by the market yet. If any of that kind of goes backwards or falls apart, I think that's a big signal for us to sell. And secondarily, it really does just come back to forward IRR. I mean, that to us, if you have a situation where you have done all your work, you're excited about the opportunity, and your checklist, things really line up. Again, we don't make that many investments, so we generally invest where things really do line up for us. And that, some of that goes wrong, there's just no kind of reason to hold on. When there's other stuff to do with the capital out there. If your thesis breaks, you have to be honest with yourself. And I think Raphi's very, very, very helpful in kind of always, testing each other and making sure that the reasons why we own something still exist.
Yeah, thesis drift is very dangerous in this business, and it's something Mark and I have talked about before, about just the honesty we need to have with each other, whether it's the idea sort of comes from me, or the idea comes from Mark. If we believe X, Y, Z, and then the facts are not playing out that way, you can't just be like, well, X, Y, Z didn't play out, and it's the next, we're on to the next, letters. If we have a thesis and the facts are not going against it, we have to be willing to recognize that moving on to the next thesis and holding on just because you're being hopeful is not a good strategy.
So as one of my last questions, so you have this 12 years of experience working on the foundation with strong partners at Stonehouse. With what kind of partners does your approach work best, like from the investors in your fund side?
Right. I think people, obviously that, our results, are lumpy. And so people have to be prepared to accept periods when their monthly statement is not what everyone wants to look at, frankly. And us, Raphi and I being the largest investors in the fund, we, definitely feel those periods just like everyone else. I think you have to come into our fund, and I think that is what people who have selected into our partnership, knowing that it's not going to be a straight line, and kind of understanding that process, and it takes time to build up that level of trust with us managing the capital. Raphi, what do you say?
Yeah, I mean, people who it's the limited partners who just recognize that, like, obviously they're not going to invest all their capital with us. I mean, and so they recognize, listen, obviously indexing is a very good choice for a lot of people, but if you choose not to index, investing in a lot of different managers that are all diversified ultimately is going to get index-like returns with higher fees. I mean, it's mathematically impossible not to at some point if you're invested with a bunch of managers and they're all very diversified. So our investors have self-selected us because they're looking for people who are willing to concentrate in a handful of ideas that resonate with them for a variety of reasons, and they realize that the long term can be quite good, but quite lumpy, and therefore, like, they're not. They kind of go in immediately with the right mindset. That they rather earn the higher, lumpier return than try to get the smooth, lower return. And by finding those select handful of investors who think like that, enables us to succeed, because we don't, when we have a month that's not great, which is inevitably going to happen when you own, you only own a handful of positions. We don't get any calls. Nobody's, nobody's, beating down our door saying what's going on, because they have the right mindset going into investing. And I think Mark's approach to transparency with limited partners resonates a lot with them, and that the transparency is very, very, very is there for them, and therefore it helps them understand our process.
My last question is always, or is the offer to add something we haven't discussed? Is there anything you want to add?
Yeah, I mean, I think it's essential. I think in building up Stonehouse the last 13 years, transparency, both with our partners and kind of the companies that we invested in, the management teams that we meet. I think that's been so critical to what we've done. We don't get many inbound calls from our LPs when they want to know about stuff. They wait for our letters and stuff, but we're always kind of reaching out, updating people, letting them know our thoughts of our LPs in the fund, and I think that's been critical to building trust and getting that flywheel going. Raphi, what would you say?
Yeah, so I've been with Mark now, as we talked about, 5.5 years, and I think it's a testament to Stonehouse and Mark that whatever level, with the level of success Mark has been able to achieve, he hasn't changed his approach in terms of how he thinks about people and the way we should communicate them. I think it's an important lesson, because obviously, you start off and you don't have a track record, and obviously you might act a certain way, and then some people gain a certain level of success, and they might change their attitude to how much they have to communicate with people just because now they're at a different point in life. But I think Mark, because it's just who he is, has stayed the same. And I think that's been incredibly important in terms of the durability of Stonehouse.
And thank you very much for the insights into building Stonehouse and turning around money stones. Thank you very much for coming on. It was a pleasure to have you. And to the audience, thanks for staying, and bye-bye to the next episode. Bye.
Thanks,
Till